Okay, we're going to start now. Tonight, we're going to talk about the awesome oscillator and also the Fibonacci filter, the EMA Fibo filter. So, some of you have just started taking the Elliott wave modules. And in Module 2, which you're currently learning, in Module 2 we learn about the impulsive wave structure, the trend moves. That's what we're learning about, the trend moves. And part of understanding about the trend moves is understanding how to decipher when the end of the trend is near. So how to determine the end of a trend. In the course, in Module 2, in Learning Object 3, you learn about the awesome oscillator. You also learn about a moving average system called the EMA Fibo filter to teach you how to get into trends and when the trend is ending. Tonight, I'm going to focus on the awesome oscillator and the EMA Fibo filter so that when you do review Module 2, it'll be a review for you. And Module 2 of the Elliott wave course will be discussed next Wednesday. That's the date, next Wednesday at noon Eastern. So there are 3 learning objects, and after reviewing the awesome oscillator and the EMA Fibo filter this evening, we will be able to review other parts of the module next week. The awesome oscillator was an indicator that was developed by Bill Williams. He wrote the book Trading Chaos. He actually wrote 3 books. I studied with him in the mid-90s. I worked with him in a tutorial in his home with 4 other traders for, I guess it was close to a week. And that's when I learned about the awesome oscillator and how to use it to look at 5-wave sequences and to determine the end of a 5-wave sequence. It was his way of showing how to count a 5-wave sequence without going through the labeling process. And it made counting waves very easy for me, because it meant that I didn't have to sit there and really try to figure it out and label it as you see Michael doing on a day-to-day basis. So that was the start for me of simplifying the Elliott wave. So I'm going to share those thoughts with you tonight, and we're actually going to go through how he teaches, how Bill Williams teaches to use the awesome oscillator. There are a number of uses for it, and in his 3rd book he actually introduces another use for it, which I'm going to introduce to you this evening. But first, are there any questions or comments? The awesome oscillator is actually the 3rd method in Learning Object 3 for determining the end of the trend. So this is straight from the course. We're going to go through the course material here, and then I'm going to add some additional thoughts. So one way to identify the end of a 5-wave sequence is to look for divergence between waves 3 and 5. And we do that by using the awesome oscillator. It's known as the chaos indicator. So what is the awesome oscillator? The awesome oscillator is actually a 5-34-5 MACD, which takes a 5-bar and a 34-bar simple moving average plotted in a histogram of 100 bars and a maximum of 140 bars on the screen. Now, let's break that down. So it's a 5-bar and a 34-bar simple moving average, and it works very effectively when it's plotted in a histogram and when there are between 100 and 140 price bars on the screen. So if you're looking at an hourly chart, and if you can get between 100 and 140 bars on the screen, then you're going to be able to see the 5-wave sequence, and the awesome oscillator will show you divergence. When you have fewer than 100 bars on the screen, you might not get the desired effect for the awesome oscillator. And similarly, greater than 140 bars on the screen might be too many. You're going to see too much of the histogram. I'll show you what I mean in just a minute. Let me put up a chart to illustrate this point. This is the euro. It's a 5-minute chart only. Now, actually, let me put up the 15-minute chart, because it looks like there are more than 100. I haven't figured out how to tell the correct number of bars on the screen. Let me just move to the 15-minute. Let's review the awesome oscillator again. It's always, first of all, it's always measuring an Elliott wave of some degree. So if the wave under consideration, so the 5-wave sequence under consideration occupies fewer than 100 bars, the MACD will be measuring the Elliott wave of a larger degree. If the wave sequence occupies more than 140 bars, the MACD will be measuring an Elliott wave of a smaller degree. You can also use a MACD with the standard setting or change the settings to a 534.5 to conform to the awesome oscillator. So what did we just say there? We said that if you don't have awesome oscillator on your charts, you can mimic it with a MACD. You can actually put a MACD histogram on it, and you see the green signal line tracing over the histogram. So you can set up a MACD using the same 534.5 to conform with this awesome oscillator. So again, the awesome oscillator is a momentum indicator. It takes a 5-bar and a 34-bar simple moving average, plots it in a histogram. So that's what you see, the green bars and the red bars. And there's a green signal line that traces the histogram. And the green signal line, along with the histogram, tells us a lot about momentum. So we're going to talk about momentum in a second. First, let's talk about, again, the divergence between the wave 3 and the wave 5. So I'm going to put, hang on one second. I'm going to just draw on this for you. I'm drawing 2 circles here. And I'm drawing I'm showing you the peaks of the awesome oscillator lining up with the peaks in the price. Now I'm going to draw trend lines on both the awesome oscillator and the price. What you see here is that price is making a new high. And just below the awesome oscillator, you see that the awesome oscillator is not making a new high. It's registering a lower high. So that's what divergence is all about. It means that when price makes a new high and isn't backed by momentum, which is illustrated by the awesome oscillator, it means that the price The price action, the price activity is running out of steam, and the market will likely turn around. So, on this 15-minute chart of the euro, we see a nice 5-wave sequence as determined by the awesome oscillator. So even if you don't know how to count the 5-wave sequence, you can use the awesome oscillator to count it for you. This is one way of determining the end of a trend. When you see something like this, you have to recognize that we are going to have some sort of a correction. We don't know how deep the correction will be. That's the subject of Module 3. But what we do know is that we will have a correction when we see divergence of some sort. When you don't see divergence in a 5-wave sequence, and let's say that's what we mean by putting the right number of bars on the screen. You have to play with it. You might go to one time frame higher and one time frame lower just so you can see the divergence on the screen. Now let me explain what that means. First, let's back up and talk about a wave 3. We learned about the 5-wave sequence, and we learned the characteristics of the 5 waves during the week. Now, wave 3 is the strongest of the 3 waves. So the awesome oscillator can pick out the wave 3. How do you know where the wave 3 is? Type it in if you can see where the wave 3 is. And I'll write it in when you're typing it in. You can tell because the top or the bottom, in this case the top of the wave 3, will be the highest price that occurs between 1 and 5 bars on the oscillator prior to the top or bottom in the oscillator. So when you see the oscillator peaking out, and it usually lags by 3 bars, between 1 and 5 bars. So when you see the oscillator peaking out, that's your wave 3. Okay? So if you were to have your awesome oscillator on with the 5-wave sequence, you can tell where I've labeled a 3 that's the 3. And it's likely that the 5 follows the wave 3 because the awesome oscillator has a lower peak. So the awesome oscillator identifies the top or the bottom of the wave 3. That's your first clue. That's what we use it initially to determine the wave 3. Now, how do you know that the wave 4 has completed? Well, the awesome oscillator tells us that as well. The oscillator determines the end of the wave 4, or when its minimum requirements have been met. And this is illustrated, or this is evident, when the histogram comes back to the 0 line. So in this example, you can see right here, the histogram comes back to the 0 line, and that tells us that the minimum requirements for the wave 4 have been met. And in this case, the wave 4 is a sideways price action. This is a wave 4. It's sideways. All we need to know is, have the minimum requirements of the wave 4 been met? And we know that because the histogram crosses the 0 line. Now, in this case, we're in an uptrend. So immediately after the top of the wave 3, we notice that the histogram starts to move below the signal line. So right here, we have some red bars forming, moving below the histogram, or the signal line. So when the market is moving higher, the green bars surpass the signal line. That's what's happening here. You have green bars piercing the signal line, and that's bullish. That's a sign that you want to be long the market. But as soon as you see the signal line turning down and the green bars turning red, that's your first clue that perhaps the market is running out of steam and needs to correct for a wave 4. So it might be a good idea to either lighten your position or get out of your position because you don't know what structure the wave 4 will take. If it's a sideways structure, then you can hang on to your position. But how do you know that? You don't know that. You cannot predict it. So to be prudent, you might exit your position here and then wait for the signal line to come back to the 0 and for the histogram to come back to the 0 line before thinking about buying it. Up here, the market is overbought. Okay? We just traded up for wave 3. The market is overbought. Down here, the market is at a reasonable level to buy again. It's at a reasonable level to buy because and it's indicated by the awesome oscillator coming back to the 0 line. So what happens? Subsequent to the minimum requirements for the wave 4 being made, price starts to head up again. And the histogram actually starts to head up. We have green bars once again trading above the signal line, and once again the market buys the euro, and once again the market peaks, but at a lower peak than that of the wave 3. So we would label this the wave 5. Now, the signal line actually tells us that momentum is running out of steam in both cases. So whenever you see red bars, when you're in a long position, you see red bars, whether it's the wave 3 or the wave 5 starting to form and moving down, it means that price is either going to correct down or price is going to correct sideways. So you can have a correction where price doesn't trade down very much and just trades sideways, and as in this example, that's because the trend for the euro is extremely bullish. During the last couple of days, it has been very bullish. Caught the market by surprise. The euro traded higher and really didn't give much of a pullback for any further buying. So we don't know, again, what type of correction we're going to have. We just know that we want to see the awesome oscillator come back to the 0 line so that we feel more comfortable in our long euro position in this example. So again, 2 ways to play it. You can hold on through the wave 4, or you may decide to take profits and wait till the histogram comes all the way back to the 0 line, which indicates that the minimum requirements for the wave 4 have been met. Now, the oscillator divergence that we explained earlier indicates the end of the trend and that the top of the wave 5 is met. Now, when we see divergence in the oscillator, that tells us that we are in a wave 5 versus a wave 3 in this time frame. Going back to the signal line, this is another use that the awesome oscillator and the signal line signals a change in direction of the current momentum. And we can see that, we already discussed that, we can see that with the green histogram and the red histogram and the signal line. You can see the change in the current momentum. When you see green bars moving up, the momentum is to be long. When you see red bars moving down, the momentum is to perhaps telling us to perhaps get out of our long positions. Now, on this time frame, you may or may not get out of your position. It depends how you it depends if you're willing to weather a wave 4 correction down to, let's say, 38 or 50% of the wave 3 move up, which are common Fibonacci retracements, which you will probably all know about already, but you will certainly learn more about that in Module 3. So again, it's really up to you. So, just to review, 4 uses for the awesome oscillator. 1, the awesome oscillator identifies the top or bottom of wave 3. Let's go back to the summary page. It identifies the top or bottom of wave 3. 2, and that's the peak in the awesome oscillator. 2, it determines the end of the wave 4 or when the minimum requirements have been met. And that's when the wave 4, the awesome oscillator, rather, goes down to the 0 line. 3, it indicates the end of a trend and top or bottom of wave 5 with oscillator divergence. That's when the price makes a new high and the oscillator does not. 4, it signals a change in the direction of the current momentum. And that's when you see the histogram moving above or below the signal line. So again, when the histogram, when you have red bars moving below the signal line, you want to entertain getting out of a long position. If you, in the case of an upward trend, if you have green bars moving above the signal line, then you feel comfortable being long when the trend is up, and you stay in the direction of trend. You feel comfortable being long the market. And the example that we looked at was the euro. Are there any questions?
With the signal line being above or below the histogram, is that also relative to the 100 and 140 bars related to each time frame?
No, the 100 and 140 bars related to the time frame has more to do with getting a 5-wave sequence on the screen and seeing the divergence and seeing the minimum requirements for the wave 4. Now let me show you something else here. We're looking at a 15-minute chart on the euro. We can see 5 waves, a 5-wave sequence here. Now I want to zoom in on this section here. This is a wave 3. Is it not? You can see that this is a wave 3. Deanna, do you see the charts now? This is a wave 3. What we're going to do is we're going to zoom in on this wave 3. We're going to go down to a smaller time frame. I realize we're already on the 15-minute, and I very rarely look at anything less than a 15-minute, but I'm going to move down to a smaller time frame so that we can blow up this 5-wave sequence on the screen, and we can see what happens with the awesome oscillator. So let's do that right now. I put the 5-minute side by side the 15-minute. The 15-minute is to the right. That's the 5-wave sequence that I wanted to zoom in on. Okay, this 5-wave sequence. Now, when we actually, let me zoom out a little bit so you can see. Hang on. This was the 5-wave sequence that we were looking at on the right. And you can see the divergence between the waves 3 and 5 in the awesome oscillator right here. Now, what I've done on the 5-minute chart is I've zoomed in on this piece. So you see the awesome oscillator breaking into two pieces. When you look at a smaller time frame, the 5-minute, you actually see divergence again. In the 5-wave sequence. So it really doesn't matter what 5-wave sequence you're looking at, what time frame you're looking at. The markets are fractal in nature. The patterns repeat themselves over and over again. So you can, if you wanted to zoom in on this piece on a smaller time frame, you would have seen that that this sequence also completed a 5-wave sequence and that we were due for a correction. Why? Because you see divergence in the awesome oscillator. So does everybody see that? The 15-minute includes the wave 5. The 5-minute is just the wave 3 of the 5-wave sequence. And Daniel, you're asking for the wave 1 and the wave 2 as well. You know, when I use the awesome oscillator, when we use the awesome oscillator, we really don't need to know where the wave 1 and the wave 2 are. We can just, you know, we're not interested in that necessarily. It's not a wave counting class. This is a class just to show how you really don't need to know where wave 1 and wave 2 are. I can show you, but the awesome oscillator doesn't tell us that information. The awesome oscillator only shows us the peak in the wave 3, the peak in the wave 5, and the fact that it is the wave 5 and the awesome oscillator doesn't make a new high just means that we're nearing the end of a sequence, of the 5-wave sequence. And that's because of the characteristic of the wave 3. That's usually the most powerful of the wave sequences. And as we learned about the wave characteristics. Are there any questions on this now? Well, let's look at the example that we used in the course. This is a daily chart of the pound from December 04 to 05. So we've counted the 5-wave sequence here. Now you see a number of divergences here, and that's okay. I mean, this is the daily chart. So let me show you that the fact that you see this price action right here, or this oscillator, this just ensures that the minimum requirements for the wave 4 have been met. Why? Because we've crossed the 0 line. We actually crossed the 0 line a number of times. That's fine. Depending on the type of correction that the wave 4 does, determines how many times the oscillator the histogram will cross that 0 line. But you can clearly see the blue circles indicating the wave 3 bottom, the wave 5 bottom, and then the subsequent bottoms in the awesome oscillator and the divergence between the wave 3 and the wave 5. This is a great little tool to use in any time frame. So if you're a momentum or a day trader and you trade the 5 and the 15-minute chart, you can use this tool to know when not to be long anymore or when not to be short anymore if you're trading a trend move. So if you're trading, let's say you decided that you were trading the euro, trading the trend up for the euro, this is definitely a tool that you would have in your toolbox, because you don't want to be buying when the herd, with the herd. You want to be liquidating your position when the awesome oscillator is telling you to do so. Now, it doesn't always catch the top or the bottom of a five-wave sequence. As you learned in Module 2, or you're about to learn in Module 2, sometimes a wave extends, and sometimes you see multiple divergences. So sometimes you might get out too soon just based on the divergence between what you see as a wave 3 and a wave 5, because you see multiple divergences. You'll actually see a wave 3 and then a wave 5 of 3 and then a wave 5 potentially, with the awesome oscillator just making, in the case of a downtrend, making higher lows each time. So just make a note of that. Let me put up another chart, and I'm going to read from Bill Williams' third book, where he talks about the awesome oscillator, and I'm going to tell you another way that he introduced how he uses the awesome oscillator. Let me put up another chart. So let me just read you a couple paragraphs. It's entitled, Understanding the Awesome Oscillator. The awesome oscillator provides the keys to the kingdom when properly understood. The AO can be used in trading both stock and commodity markets. It measures the immediate momentum of the last 5 bars and compares this figure to the momentum of the last 34 bars. Now the next paragraph is pretty important to understand. So listen carefully. We know that price is the very last thing to change in the markets. What changes before price is momentum. What changes before momentum is the speed of the current momentum. What changes before the speed of the current momentum is the volume, and what changes before the volume is all of us traders and investors making chaotic decisions about our activities in the markets. Now, if you understood that paragraph, you get a gold star because it's pretty confusing. So the first thing that happens is that traders and investors make chaotic decisions. In other words, they take their trades. They buy or sell. That's the activity of traders. We buy and sell in the markets. And then there is no indicator, there is no volume indicator for the cash markets per se, but if you do trade the futures markets and you trade currencies on the futures markets, the future market tracks volume, so there is such a thing as a volume indicator. So actually, many futures traders use volume as an indication that when volume picks up, that's real volume. That means that when volume picks up and when price picks up, that's a good thing. It indicates that the trend is strong. When price picks up and volume falls off, it means that the market is moving up on air. So that's similar to divergence in the awesome oscillator, telling us that momentum is running out of steam. So when you do have volume on your charts, when you are looking at the futures markets, maybe not currencies, but other futures markets, volume is an indication as to whether the move is real or not. So next, the volume changes. And then the speed of the current momentum changes. Now, the speed of the current momentum, that's indicated by, I would say that the signal line indicates the speed of the current momentum, because that's almost the slope. When it has a steep slope, the steeper the slope, the higher the speed. And then momentum changes. So this indicator, again, when the green bars, the histogram trades above the signal line, the momentum is up. When red bars start to form, trading below the signal line, then the momentum is running out of steam. Momentum is down. It's time to think twice about being in the market. And until you see the divergence between the wave 3 and the wave 5, you might decide to hang on during this wave 4 corrective sequence. You might decide to hang on. You might have another indicator which tells you to get out. You might be moving averages alongside the awesome oscillator. And in fact, we're going to show you the EMA Fibonacci filter in just a minute. Let's see what else Bill has to say. When understood and used properly, the AO is the best and most accurate indicator we have found in almost 50 years of trading. If you really know how to use this indicator, it should be worth at least 7 figures to you in the next few years. You hear that? 7 figures, guys. Now, what he says next is he's actually suggesting that when the oscillator turns down, so when this oscillator right here, when it peaks out and when it turns down, you could simply call your broker and say sell the market and stay short, until it turns back up again. He suggests that, but he says that he doesn't recommend that, obviously. I mean, you can't just do that. A lot of other factors come into play. Like I wouldn't do that. I would only do that at the end of a 5-wave sequence, not at this point here. I might liquidate a position, but at this point here, I would use, perhaps a 1, 2, 3 reversal pattern to go short, to go the other way when I see this divergence. So you have to be careful. You can't really. He's not suggesting that you do it, but he believes in the indicator, and he's saying use it in conjunction with something else. But let me tell you how he does use it. At the beginning of a trend, he would buy the market on the he would buy the market on the 3rd green bar of the awesome oscillator, so pretty well right here. That would be a second entry signal. His first entry signal would, now I don't have his other indicators up, but that's, in his book he writes about 3 entry signals, and I'm not going to tell you what they are. But he would look to buy the market if his other indicators line up, and he would buy it at the 3rd green bar moving above the signal line. So I'm not suggesting that you do that, but what I am suggesting is that you have a look at it, and certainly before you start to use this indicator, back test it on a number of currency pairs or on one currency pair. Look at it very carefully on different time frames that you trade. So you might look at it on the hourly, you might look at it on the 15-minute, you might look at it on the 5-minute, and see how it works. Just go through a bunch of price bars along with the awesome oscillator. And if you don't have the awesome oscillator, set up your MACD like the awesome oscillator as we described. So he actually does use the, hold on, I got it wrong. I got it totally wrong. He uses this indicator to buy or sell at the end of a trend. So in this example here, if we had a 5-wave move higher, what he would suggest doing is to sell on the 3rd bar, the third red bar after the peak. So the third red bar, the histogram moving below the signal line, that's where a short would be entered. All right? And so, in other words, not at the beginning, well, in this case, since we see the end of the 5-wave sequence, we know this is the end. This is the entry point right here. So at the end of 5-wave sequences, that's how he would use this indicator. Now, we would use it as well in conjunction with a 1-2-3 reversal pattern or some of the other other ways that we show you in Module 2 on how to find the end of the trend. So now we're going to move to the EMA Fibonacci filter, and we're going to see how we can combine the EMA Fibonacci filter with the awesome oscillator in our trading. The 8, 13, 21, and 34-day EMA filter. These are all Fibonacci sequence moving averages. That's all they are. 8, 13, 21, and 34. You learned about the Fibonacci sequence. So what it is 4 moving averages on a chart. And I don't know if you can see them. You can. The yellow doesn't show up too well. But just know that there are 4 moving averages on there. Now we're going to talk through how you can use moving averages to determine when you get into a position and when you get out of a position. And notice we have the awesome oscillator below as well, and you see the divergence between the wave 3 and the wave 5. The 3 circled and the 5 circled. So to use the moving average, this moving average system with the awesome oscillator is a good little system on its own. What we use in the OTA, we tend to use the wavy tunnel, and the wavy tunnel is not described in the course, but there are some people that use and feel very comfortable with this EMA filter, Fibonacci filter system. Now, first of all, just a note on moving averages. Moving averages are trend-following systems, and when you determine that you are in an uptrend, or in this case a downtrend, and this is the daily chart, but what you would normally do is you would look at your daily bar and see if the day, to see what the trend is of the move. If the daily bar is up, then the trend for the day is up. If you can use the moving averages to tell you if the general trend is up as well. So if both the general trend and the daily bar are up, then there's a good chance that trading is going to be positive that day. Now, in understanding the Elliott wave sequence, you will know also whether you're in whether you're in a wave 2 or a wave 4 or simply in a wave 1, 3, and 5. So you would want to put this all together to sort of figure out what the trend, for the day is. And if you determine that we're in a wave 3 by looking at the general trend and by looking at the daily bar and by looking at the actual candles on the daily chart, if you determine that we're in a wave 3, then you're going to want to use moving averages to get you into a trade. So we're going to talk about these moving averages in terms of getting into a trade and exiting a trade. Excuse me. Excuse me. Okay, let's talk about the EMAs. First, some observations. Let's say you're in a trade and you're short. Let's say we're trading the wave 3 in this example, and you see the green 1, 2, 3, 4, and 5. We're trading the red 3 in parentheses. Let's say we're short the market. And the 8 EMA is your shortest EMA. That's going to be the most sensitive. So that's going to move first. That's going to cross down below the 13, the 21, and the 34-day EMA filter. That's going to cross down. When the candle pierces the 8-period EMA, it serves as a warning of a pause in the trend. So as long as price stays below all of the EMA averages, that's fine. We're in trend. The trend is down. As soon as the candle pierces the 8-period EMA, it serves as a warning of a pause in the trend. Now, what I think I'm going to do is I think I'm going to put up the Euro sequence that we were just looking at with this EMA Fibonacci filter and talk about that in this context. Just give me one sec. I apologize. I'm just helping somebody out here with something. Hold on. Okay, in this example, let's start again. I apologize. The 8 EMA is the blue line. Let me make that green. We have 2 blue lines here. Here we go. The 8 is the green, the 13 is the yellow, the 21 is the blue, the 34 is the purple. You can see that as the euro trades higher, you can see that the green trades above all of the other averages. So when the 8-period EMA is pierced by a candle, it acts as a warning of a hesitation in the trend. That's the first observation. The trend will continue if the close is above all 4 EMAs, if the candle close is above all 4 EMAs. But if the close is below the 21 and the 34-period EMA, it's a signal that an eventual pullback or a reversal may be imminent. So at this point, the 8-period EMA will cross below the other averages, and you will see convergence, you will see the averages coming together, and you will see the crossover. And that's what you're seeing right here. So you see the green average crossing over. This is also what we've denoted was the wave 3 peak. So we already know from looking at the awesome oscillator that we are due to have some sort of a correction, and that's confirmed by the averages. So what you will see is you will see the shortest moving average, the 8, crossing over. So that's also another indication that you might liquidate your position. First you see the awesome oscillator peaking, and in this example, this is showing us that this is the wave 3 of the 5-wave sequence, and this is actually the wave 5 of the 5-wave sequence on this 15-minute chart. And when we looked at the 5-minute chart, with this 5-wave sequence, we actually saw the price action coming below the 0 line between the wave 3 and the wave 5. So the wave 4 did bring us below the 0 line on the awesome oscillator when we went to a smaller time frame. Some other observations. The price action hugs the moving averages. And notice that at the end of a wave 1, 3, or 5, so in this case, the wave 3, the price action moves away from the averages, sometimes in an impulsive frenzy, okay? And that's when, you know, the market is getting really, really excited, and we're looking at where, at this point here, when the market, I don't know why this keeps going, when the market buys price and it trades away from the averages. This is not too much of an exaggeration. Sometimes you see a real exaggeration where the price actually moves away from the averages and then comes back to the averages after the 5-wave sequence. So take note of that. You don't want to be buying when the price is away from the averages. You want to be buying when price hugs the averages, because when they're away from the averages, they're going to come back to the averages. It's similar to the PW trade in the wavy tunnel. The PW, the price to the wave trade, it's the same exact thing. That price moves away from the averages at the end of a 5-wave sequence, and so that's our first clue that it might be the end of the 5-wave sequence, and that we will come back to normality. We will come back to the averages. I call it the rubber band effect as well. So that's another observation. And you can't see it so well on this euro because it's not the most volatile currency, but you would certainly see it from time to time in some of the other currency pairs. So when price moves away from the averages, this is the trader's emotional desires to stay with the trend. So they're getting in sort of late, even if there are signs of a completion of the trend. And then what you see next is that the price action always comes back to the averages. So there is little value in entering a position at this stage of the game, as the price will revert to the mean a few price bars later. In other words, you don't want to jump in at that point. You want to wait until the price action hugs the averages. Now, another observation is, and let me clear this, you have a 5-wave sequence up just based on the awesome oscillator. You can see that, but as you're trading this, let's say you're trading the 15-minute chart, and you decide to buy the euro when the an entry point would be when the 8 EMA crosses over all the other averages, and the averages start to trade between the 12 and the 2 o'clock position. So they're not at a 3 o'clock position, they're not flat or sideways as they are here, but they sort of come out of hiding, and they start to break away from the sideways consolidation and move upwards between the 12 and the 2 o'clock position on a clock. So you would look to enter, to go long as price breaks higher if you're day trading and you see that. Now, knowing how that the market moves in 5-wave sequences, when the market moves up to this point and you're catching it at the beginning, you're not going to be too perturbed about it coming back to the averages and staying in the position, because you know that it's going to go for 5 waves. It's clearly an impulsive structure. It's clearly not going to turn around at that point. It has more room to move. So you're going to, by understanding Elliott wave analysis, you're going to feel more confident in holding the position until you can literally count your 5 waves. Now, in this case, I would probably have a 5-minute chart side by side, and I would also be watching the awesome oscillator. So I might, be cautious at this point, and I might look to liquidate at that point because the awesome oscillator is, is peaking out. Or I might decide to just wait a bit and let the averages take me out of the position. So what I mean by that is when the averages start to cross down, you might want to just liquidate or at least maybe reduce your position by a third or a half. But understanding that the move is going to make a five-way sequence and that we haven't seen divergence yet between the awesome oscillator would be our first clue that we have a little bit more room to go. In a really strong trend, when the market is moving up and up and up, you can take the opportunity to buy when price comes back to the moving averages. So if you see, a wave 2, a sideways consolidation, and we come back to the averages, and that's when you would be interested in buying once we come back and we're ready for our next impulsive move up. Now that you understand Elliott waves, you understand that the starts and stops, the move up and the sideways, it's all part of the Elliott wave cycle. And they're the necessary, moves and halts in a trend, which add to the trend's momentum. And as long as these consolidations continue, the current impulsive wave is not yet complete, even though it may seem extended at a certain stage. So this move up is certainly not an extended wave, but if you went through Learning Object 1 in Module 2, you learned about wave extensions and that a 5-wave sequence can actually turn into a 9-wave sequence or a 13-wave sequence, etc. So as long as you continue to see consolidations, sideways consolidations coming back to the averages, and the averages don't cross, you can stay in, it keeps you in the trend. I'm going to show you the hourly chart on the euro, and you'll see how the move, the averages kept one in the trend. Actually, I'm going back to the daily. So the move beginning right here at this point, this is the 130.34 level or 133.50 level. From this point here, when the 8 EMA crossed over the other moving averages, the 8 EMA never ever crossed back down through the averages. So if one were just trading off the system off the daily chart, one would be long still. Now notice, this is the example that I spoke about when price moves away from the averages, and it always comes back. So in this case, the market corrected about 200 pips. Here's another example where price trades away from the averages and it comes back again. Now, these peaks happen to be peaks in the awesome oscillator as well, as you can see. Now, on this 5-wave sequence, you do not see divergence in the you see divergence in the awesome oscillator, but you do not see the histogram coming back to the 0 line, which means that the minimum requirements for the wave 4 have not been met. So this is a good example of when you would actually move to a smaller time frame, a 4-hour chart, to get more bars on the screen so that you would see the wave 4 retracement in terms of the awesome oscillator. and you would see a proper divergence on the chart. I'll show you what I mean. Actually, I didn't capture the entire sequence. You know, you have way too many bars on the screen. But if we just look at this portion right here, you see that we don't see divergence happening until just now, potentially. So on this last move up in the euro, it looks like we will end up having divergence on this last move up finally, but certainly we have convergence during this piece right here. There is no divergence during that piece right there. Convergence is when price moves up and the oscillator moves up, so there is pretty strong momentum. It's pretty obvious here this is some sort of a corrective behavior. Why? Because the awesome oscillator comes down to the zero line. And then we start to take off again. And look to see what happens. Even on the 4-hour chart, the moving averages are at the 3 o'clock position, so they're sideways between this area and this area right here. They're sideways. And then once, and this happened overnight, once people started to go in and buy the euro again, the averages started to spread apart. That gave a nice buying opportunity for the Europeans, certainly not the North Americans who were sound asleep when the euro took off last night. So now we have to watch to see what happens, but it looks like, you know, the euro could be running out of steam, at least on the 4-hour here. Now let's just spend a few more minutes looking at the illustration from module, Learning Object 3 of Module 2. So this move is a move in the euro, the daily chart from March to August 05, and it's actually the 5-wave sequence of wave 3. So you can see the 3 in parentheses at the bottom, and you can see the green 1, 2, 3, 4, 5. So it's a 5-wave sequence. You can see how the price action trades with the combination of the EMAs. So starting at the beginning of wave 1, the EMA Fibonacci filter gets us into the first short position when the 8-day EMA crosses all 3 EMAs. And so that's where you see the first circle. The EMA crosses all 3 EMAs. Gets us into a position short. You don't get in at the top, you get in on the 4th red candle, the 4th candle down. Now, you can use all these averages as an entry system, as an exit system. So if you want, you can use it as an exit system. You might exit a portion, like a third of your position or a quarter of your position, let's say, if the 8 EMA crosses over the 13 EMA, for example. So in this case, in the wave 2, the 8 EMA crosses over the 13 and the 21, but does not cross the 34. So if you broke your position into thirds, you might take your profit on 2/3 of your position, and then look to get in again when the EMA crosses back over the down through the averages. And sure enough, the AEMA does cross back through the other averages, and you can re-enter the position again. And you actually keep your position during the entire wave 3 move, and you don't exit your position until the third blue circle, where once again the AEMA crosses back over the 13, the 21, and finally the 34. So you can actually ride your position down and get out when the moving averages cross back. You don't have to go long. You can filter your trades. You can just enter in the direction of trend and determine what the trend is and determine that you want to be short in this case and sell. You don't need to buy just because these moving averages are crossing back up. You buy to exit your trade, not to go long, especially if it's going against the trend. Now the other thing to note, again, is when price moves away from the averages, we always move back to the averages. So here's an example at the end of wave 1. Here's an example at the end of wave 3 and wave 3 of 3. We're always moving back to the averages. Back to the averages. Now, in this case, you would also want to put the awesome oscillator below the chart, and you would want to see, you would have confirmation from the awesome oscillator. We don't have it here, but you would definitely see confirmation. You would see divergence in the awesome oscillator on this 5-wave sequence, further confirming that you might want to exit your position anyway. So you get a double confirmation, one from the awesome oscillator divergence and 2 from the moving averages crossing over. So that's about it. I showed you a little preview of what you're going to learn about in Module 2 of the Elliott Wave course. You know, learning how to use the EMA Fibonacci filter system, which is a simple moving average system in conjunction with the awesome oscillator. And it might not be, you might want to check it out and see if it resonates with your personality, your trading personality. You can certainly use this on any time frame. And it's just something for you to check out. So really everybody is different. You will find your niche. You will find what works for you. You just have to try out a few different systems. And of course, when you use this in conjunction with your newfound knowledge of Elliott wave counting as, you know, the background, as your confirmation of where we are on the roadmap, then it's just it all fits together. Are there any questions? So if you're not asleep already, it's probably time to go to sleep right now. But thank you very much. And that's it.
Thanks, Jody.